Well, hey there. Today I decided to make a different kind of video, not my usual video. I'm in a beautiful Chicago botanic garden. I live in Chicago, well, not Chicago City, but Chicago suburbs. So that's what it is. That's why the background and still the green trees, even though we're right in the middle of September. But anyway, so what I wanted to discuss today, again, it's just because I was talking to a friend of mine earlier this week, and he was basically one of these people who invested money into the mutual funds because bankers said so, or because their company and 401k account said, okay, that's what you need to do, right? So you just need to put money in some fund, like 40% fund, 60% equity, 40% into bonds, and you hold it there. And obviously when the April was around, as everyone most likely aware, if you had any kind of fund at the time, that the funds, this type of funds went down because the market went down. Because equities, even in the 60-40 kind of portfolio, the equity is a big portion of it. And if you really paid attention to this type of stuff back in 2022, year 2022, this type of portfolio went down even more than the typical, because in 2022, because of the inflation and the raised rates, the bonds were going down, and so did the equities. So basically you got the double whammy, and there was no escape, there was no safe haven per se at that point in time. So both cases, it just continues plummeting. Especially bonds really plummeted during that time. And that is why there were so many banks which failed at the same time. I don't know if you're aware of that, but there was a lot on the news at the time that, oh, bank is XYZ failed again, and they couldn't bail it or couldn't do anything about it because of the rates going up. Okay, so anyway, so what I was talking to him about, and he was like, okay, give me the the elevator pitch. What is so different from what you do versus what everyone else does? And I decided to look up the statistics, by the way, for it, and said, okay, who is the active trader versus the general public, kind of a general investor? So it's not total population of people, but what's the number of people who are at least in the market, okay, versus the type who are actively trading in the market. And it turned out, according to ChatGPT, the statistic is around 11% are active traders versus 61% of investors / buy and hold type of traders. So the ones which are buying some kind of a fund and holding it, riding it, basically, in my opinion, they're just hoping for the best. They're holding the fingers and say, okay, let's write it out, because historically the funds were always going up, and that's the reason why I just need to sit through it. Okay, so that's the statistics. I basically belong to that 11%, obviously, but I'm not a day trader right now, and I'm not a swing trader either. I'm not doing this type of trading. I'm doing a different type of trading. So my elevator pitch is, okay, I'm not like a 90% of people out there. What I'm doing, I'm using rules. Specific, it's called systematic trading, and I'm using rules for it. So using the rules lets me to clearly define when I need to open a certain position for a certain stock and when I need to get out from the position from that certain stock. So that makes it easier for me to really be less emotional and don't stare at the screen as well. So, like, I know the day trader is an example. They have to stare at the screen because they're trying to capitalize on little tiny motions and in the market, and it's all great except that it is nerve-wracking. Hold on a second. And since it's nerve-wracking, I mean, I was a day trader, just so you understand. I know it from my personal experience. If somebody has a question about day trading, yeah, ask me as well if you want to, and leave a comment, especially for that video. But otherwise, that's the reason why I don't want to watch the market all the time. I'd rather have systems do the work for me, and that's the reason why I reserve to do it by the rules. Meaning that I came up with a rule, specific rule, when to get in to certain stock, when to get out. Same rules dictate to me which stock to actually choose from as well. So I'm have my own personal stock screener in essence. The software that I've developed, that's called Quantum X. Some people already know it. It's been becoming more and more known in the market. It's been developed 5 years ago, but I mimicked another type of software, so it's not groundbreaking per se, but it has some features which are groundbreaking. Again, I'm not trying to brag about the software, but basically what it does, it lets me to choose which stocks I need to get into based on the type of the idea that I have. As an example, if I decided to hold a certain stock like Apple or Nvidia or something like that, I can come up with rules which lets me to test them in the software to clarify what would happen when the market changes. Because in any condition, market changes. It's like it's inevitable. Market always changes. It never stays the same. And since it never stays the same, you cannot just rely on whatever happened last week or last month, even this year or last year. It's not enough to know that information. You need to know a lot more, because every single system, which is called drawdown, basically goes down because it's just inevitable. It's part of the game per se. So this lets me to choose these rules, and I can craft them for different ideas. One idea would be, well, I don't want to complicate my life, so I want to trade only very rarely, but I also want to make sure that I don't have more than 20% drawdown, something like that. So meaning that at any point in time, whenever I made a new high in my equity, I don't want to lose more than 20% as market changes. Let's say the market tanked like it did back in April, and my positions will be stopped out, right? So I will be sitting in cash. So that's easy to achieve. I can achieve it by a gazillion different means, and one of them is called long-term trend following type of system. Again, I'm trying to, it becomes a little bit more technical and complicated, but to not complicate things, it will be okay. So the rules, such as follow this certain trend for as long as the trend exists, lets me to stay in the market, avoiding the noise, and yet when it turns around, I will not encounter bigger drawdown than a certain predefined condition, which was allowing me to stay outside of the noise, but at the same time allowed me to not go down too much. So as I said, if I don't want to have more than 20% drawdown, I can achieve that. If I want to be more conservative and I want to have more than 10% drawdown, I can also achieve that. I may sacrifice my upside, I may sacrifice how much I'm gonna make, but at the same time, I can still make it so it's more reasonable. As an example, when you look at all those mutual funds, if you evaluate them by their recent performance, even let's say 5-year performance, well, you know that the 5 years is not enough to evaluate the fund. Because what was in the last 5 years? Okay, there was COVID. Okay, there was 2022 bear market. But in the last 5 years, did we have the dot-com boom and bust? No, we did not. Did we have the financial crisis in the last 5 years? No, we did not. Did we have any kind of a flash crash like in 2010? No, we still did not. Right? So all kinds of market conditions were not in the last 5 years, or even 10 years. Right? It's still not enough. You need to test a lot longer. So as an example, when I test a system based on S&P 500 stocks, I sometimes go all the way to 1960 to test it out, because I have that much data. I have the data from 1950 till now. So that way I can see what will happen when there's a really high inflation, let's say from 1968 till about 1982, 83. Some people called it stagflation at the time because the stock market was going sideways physically, and at the same time the inflation was really going up, like in 20% or higher rates, which I can actually find out if you really need to know. My data provider has that. But if you adjust for inflation, if you would have invested into the stock market, you would have lost money. So that's why back in those days, people were investing a lot into treasury funds, because treasury funds were returning something like 15% per year. Hey, it's like a no-brainer. You just invest into the treasury fund and you will receive for 30 years, right? And you receive 15% a year. What does it mean, 15% a year? Just so you know, every 5 years you will double your account. So if you had $100,000 right now, in 5 years you will have 200,000. That's 15%. If you had 20% per year return on average, compounded return, then you will double it in 3 years. This is how math works, right? So that's the reason why the typical market return right now in the past, in the past 17 years, I would say, will be around 8.5% from S&P 500 market return. If you wanted to be more adventurous per se and use something like tech stocks, the technology stocks, which is the NASDAQ 100 index, that one returned on average in the past 17 years, from 2007 till now, on average, it returned, you compounded of around 14%. So, which is great, right? So you would have doubled your amount of money 3 times by now if you would have held it in there, except it has this roller coaster ride. It goes down 50%, 40% regularly. Like the same April, same NASDAQ 100 went down, I think 22% if I'm not mistaken, or 20%. I think it was like 22%. And the small cap stocks, basically more smaller companies who had less known companies, they went down 23, 24%. And S&P 500, so more known companies, they went down 18.5% just this year in 2025 in April, right? So that's the importance of, okay, so yes, I can make a lot more money in the long run. That's what the buy and hold people typically do. Or the typical person who just keeps it in a mutual fund or keeps it in a fund which was offered by their job, by their workplace. But at the same time, they have to ride out all those huge drawdowns when the next crisis comes along, and then they lose money, especially if they need money at that moment. That's the most difficult part to do, is that it really bites you in your ass. There's no any other way to say it. People may freak out, they may take money, and then they're afraid even. I mean, I had so many students of ours who were complaining that, okay, I got the money right before the full crash, but I was so afraid to put it back in that I didn't know what to do, that I missed the bull market portion of it, right? So I literally had so many stories when people were just complaining that they were too afraid now to invest. And then I had a whole bunch of other people who were complaining to me that, well, yeah, I had to write it out. I had to go 50% down in 2008 and I had to write it out. Or like same thing in April, went down 20% or more, especially if you were investing into specific stocks, not into the market, but specific stocks. You did go down more than 20% in April, just 2025 year. But in COVID times, again, when there's lockdowns and the panic in general, it can go down 30, 40, and so on and so forth, right? So that's like Lehman Brothers in 2008 when they collapsed, that the whole market just collapsed as well. So that's the point of, you need to have specific rules to protect your money, to protect your wealth, and multiply it, because the math works beautifully as long as you use it. If you, as I said, as simple as, even if you have 10% return, I think on average it will take you 9 years, something like that, close to 10 years to return back, to double your account. So it's still good, but it's just not as good as you would think. As an example, the S&P 500 increased by around 300 something, close to 400% since 2007 by now, with all the dips, with everything, with the crash of 2008, with the COVID and any other crashes in between, basically with everything. So by now, I think because the compounded annual growth rate of S&P 500, as I said, from 2007 till now is around 8.5%. With that type of return, you still would have quadrupled your account. But now imagine that if instead of being afraid that your money will go down by 50%, and you had, let's say, more 15% return compounded, you would have been by now, what is it, probably doubled it every 5 years, right? So you doubled it 3 times at minimum. So double and a double and a double, which is like 800% or more. Probably more, right? So it's like around 1,000% return by now instead of 400% return by now, right? Again, I'm not really good right now at the math at the moment. Not trying to, because I'm not in front of my computer either. But it's just in general, the math would be so much better for you and your wealth if you really trying to do the right way and use the rules. So that's my main message to my friend, was that, well, if you don't know what the rules are, they're very simple. He's like, okay, I'm a layman, I don't know how to use these rules, I mean, tell me the idea. But as I said, like, they're very simple rules, we can test it out, I can give you those rules, and it doesn't mean that you have to trade like a really, really active trader. As an example, you can say that, oh, as long as the index that I'm in, say S&P 500, if it's above the 200-day moving average, we're still staying in it. It's very simple, like that. But if it goes below the 200-day moving average, we are out of it. Very simple, very straightforward rule. And then once we are out of it, we're just waiting for, let's say, the S&P 500 to go above the 50-day moving average to get back in. But only if we're above 200-day moving average. So this type of a rule allows me to stay put when I don't need to be in the market, because the market is in a bad condition, and yet it will let me to not outperform the market in general, because obviously you're playing with just the market, but it lets me to save my money, to preserve my money. Okay, that's very simple rule. Because I mean, he was telling that, okay, his son, very young, but he invested money with just a few shares of SPY. And it's like, okay, so how do I protect it, or what do I do? When do I get in, when do I get out? I mean, that's, as I said, this is the type of rule you can put in place. Because all you need to do is just monitor it every once in a while, just check where you are. If the market is really far away from 200, you just don't need to worry about it. You don't need to check it every day. You can check once a week. But if you're getting closer to the 200-day moving average, okay, maybe you'll need to check a little bit more often. Okay, that's as simple as that. And I can help him with this type of rule compilation, and he'll be set, right? Not a complicated thing to do. So that's the reason why, as an example, I'm holding the workshop, which will be in the link in below over here for that video. At least for the time being, that link will be accessible. It's going to be a workshop about very simple rules, what you can do to preserve your wealth and how to increase it. Simple rules, simple systems, not exactly for completely buy and hold people, right? But I'm trying to teach people that you don't have to be a buy and hold. You can be just a little bit more active to really preserve and increase your wealth. So that's the reason. Again, I'm not trying to advertise it over here. It's not about advertisement. I just mentioned it, but it's a $27 workshop. So anyway, so that's the reason why, if you actually waited that long in this video, that's your little bonus. But you can go and apply for it. It's going to be on the September 25th. So it's not that far in the future that I will be holding this particular workshop, but I will be probably holding it more regularly going forward. I'll probably vary some systems, not going to be the same systems. But just in case, if you really want to know how it all works, what it is, so I would really recommend you to join that kind of a workshop. But otherwise, you can also check all other videos. I mean, I have more technical things for that 11% of the active traders that we talked about. Or I have more explanation, like myth or bust, for the rule trading, rule-based trading. Just watch it, and if you do have questions, just send me email at info@tradingsystems.com, again in the link below the video. Also, you can just go to our site, tradingsystems.com, navigate it, and if you do want to talk to me directly, we have the apply for mentorship. It doesn't mean that you have to be part of our mentorship, but you can just apply so that I can know a little bit more background about you. And we can talk just one-on-one on our call, and I will explain how it all works again if you have more questions, how it can be applicable to you specifically, and how this does work. Okay, so I can show you what happens behind the scene, how it all works. And otherwise, I think you leave it at that for today, and till next time. Okay, bye.